All right. Hi, everybody, and thank you for joining us for our second quarterly call of the year. We're so glad you could join us today. I'm going to give a disclaimer before the presentation starts that this presentation does not provide investment, tax, or legal advice. The information presented here is not specific to any individual's personal circumstances. It's for general information and educational purposes based on publicly available information from sources to be believed to be reliable. We cannot assure the accuracy or completeness of the material, and the information presented may change at any time and without notice.
Great. Well, thank you, Carly, and thank you all for being with us here today. Lots to talk about on our call today, so I won't waste too much time going through the agenda. I'll provide a market update talking about news and recent volatility we've seen in the markets. We'll then turn things over to Dominic to do a discussion of portfolio management with some thoughts on our overall philosophy and strategy at this time. And then Peter and Dominic will discuss some of the portfolio changes that were made during the first quarter of 2026, primarily sales, but we did have one purchase that we'll review as well. And then we'll keep the lines open for some question and answer. And if you have any questions during the call today, please feel free to type those into the chat box or the question pane, and Carly will address those questions as they come in at the end of the call. So starting with our market update today, obviously the big news is the conflict in the Middle East. If we look at the next slide, what has been happening in the Middle East is that Iran has effectively blocked the Strait of Hormuz, which is one of the world's busiest oil shipping channels since the U.S. and Israel attacked Iran on the 28th of February. And why is this so important? Well, 20% of the world's oil and liquefied natural gas usually pass through this strait, making it one of the most important channels for distribution of energy on the planet. And the impact that this has had is it's sent global fuel prices soaring in recent weeks. Beyond that, Hormuz is also a crucial trade route for exports like fertilizers from the Middle East, where natural gas is used heavily in that production process. About 1/3 of the world's fertilizer trade normally passes through this strait. So this is what's going on in the world right now. And the slide here, basically, the concept is higher energy prices equal higher prices. And the chart that we put up on the screen shows how closely the price of crude oil and U.S. inflation, the consumer price index, move together year over year. Basically, when the price of oil goes up, inflation usually follows a bit later. When oil drops, inflation rates tend to fall off. You can see from this chart that goes back to 2005, that pattern repeats over and over again across different market cycles. So if we look at the next chart here, as I mentioned, one more, Carly.
Oh. What is happening? Oh.
It's okay. The setup is right for higher inflation here. And it's not just oil and natural gas. The large volumes of fertilizer, things like urea, ammonia, phosphates, and sulfur, these are all products that move through the Strait of Hormuz each year. And it's creating this major choke point for agricultural supply chains. And because energy is such a major input in fertilizer manufacturing and transportation, this disruption is quickly amplifying price volatility. And so, yeah, we've seen the price of oil spike, and gas prices at the pump are much higher in recent days. But we feel that the price of food is likely to follow in the coming months, because U.S. farmers who just had to do spring planting are now paying significantly higher prices for fertilizer, and that price will get passed on to the consumer. So if we go to the next chart here, this is very much reminding us of what happened to inflation back in 2022 in June when the war between Ukraine and Russia began. We had that post-pandemic supply chain issue that really was putting a lot of pressure on prices. And you saw back in 2022, inflation spiked to about 9.1% at its peak, with the largest contributors to inflation being that green bar energy, or green part of the bar energy, and the purple part food costs being the next highest. So we've seen inflation come down considerably since then, but we have more factors at play here. Tariffs that were rolled out last year, there's a delayed impact of those. So we would expect to start to see some of that impact hit this year. So between higher energy prices, tariffs that were passed last year, we could see inflation. We are expecting to see inflation start to creep up later this year. We don't know if it will peak like 9% again, but it certainly seems like the setup is right for higher inflation. Carly, if you go to the next slide. Yep, thank you. So what does the Fed do when inflation goes up? Well, historically, interest rates are increased to help slow things down and to curb that inflation. So if we look back at interest rates, this goes back all the way to the early 60s. We believe we're still in a very low interest rate environment historically. If you look at when interest rates peaked back in 1981, they have been falling pretty steadily for the last 30 years until very recently. And if we look at the setup today, we've got increased government borrowing, higher inflation from tariffs, higher energy costs. It seems to us that interest rates could be on the rise here in the not too distant future as well. And so if we go to the next slide, we think, well, what happens if interest rates go up? Well, if interest rates go up, they're probably going to need to, or it's probably going to create an impact on the stock market as well. Will it create a recession? We think the U.S. is better insulated from the impact of higher energy prices than other economies around the world. If you look at the chart on the left here, the U.S. is now a net importer, or the U.S. is now no longer an importer of petroleum-related products. We produce more at home than we need to bring in from other countries. And our consumer base, which is, we're a consumer-driven economy in the United States, energy costs, if you look at this chart on the right, they are not proportionately going to impact our consumer spending. Obviously, it's not evenly distributed. If you are a lower income family, higher gas prices and fuel prices have a much greater impact on the bottom 2 quintiles of earners in this country. But if we average this out across the United States consumer base and where most consumer spending happens, today's impact of higher energy prices, it doesn't indicate to us that it would create a recession in the United States, but it's certainly something that we're keeping our eye on here. So all of this to say is we've seen that markets are probably going to continue to be volatile. We could have a big pullback later in the year if this thesis of higher inflation leads to higher interest rates plays out, because money will shift out of the equity markets and into the bond markets if that happens. But this chart, my favorite chart of all time, and a routine reminder to keep our focus on the long term here. This shows the S&P 500. The gray bars going back to 1980 are what track the year-end outcome of the S&P 500, and the red dots show the intra-year decline that happened in each of those last 46 years that are tracked on this chart. You see a lot of red dots there. Every year we've had a big drawdown in the equity markets. On average, it's been 14.2% down at some point during a year. Yet 35 out of those last 46 years ended positive. So we never want to completely flee the market. We still have a great deal of optimism about the long-term potential for the United States, but we've chosen, and as Dominic and Peter will explain later, to take a very cautious approach moving forward and really focus on owning high-quality businesses that we feel trade at very reasonable prices in today's environment. With that, I will turn it over to Dominic to talk about our current positioning. Dom?
Perfect. I just want to add one thing. I am out here in Taiwan meeting with the company's management team, and the company that I'm talking with, obviously the Iran conflict came up, and one of the things that he talked about is you have crude oil and oil, gasoline, but you also have byproducts of oil refineries, which typically might be like a plastic of sorts. And the company I'm meeting with said that they are already running low on some of the plastics that they use in their packaging. And if the conflict doesn't get resolved, they are worried that they're going to basically run out of plastic, have to replace it with something else, and that replacement is a higher cost product. And so they're going to end up having to pass that higher cost on to the customer, which is exactly what you just said in inflation. So higher prices. So it doesn't just affect the transportation. There's other things that it affects as well. So I wanted to shift into the portfolio management side. And one of the reasons is when you look at the way our portfolios are constructed versus the way the S&P, the NASDAQ are constructed, we are not the same. We are not the same portfolios. Our portfolios today are significantly different than what you would typically see in other portfolios in the market in general. So wanted to walk through how we're positioned and why we're positioned the way we are, and just what we look for when we're looking to buy or sell positions, because as you probably noticed, there's been some turnover in the portfolio as of late. So starting with what we've been doing the most as of late is selling positions. And the two main reasons we're selling a position is the thesis breaks, meaning we are wrong or the thesis is changing, or the risk reward is no longer attractive, and therefore we shouldn't own the position because maybe the downside is greater than what we view the upside as. So starting with the thesis break, some sort of event typically will occur that does not align with what we thought would occur when we made the initial purchase or subsequently to that. So an example, this might be a company makes a large acquisition that they fund using leverage, and leverage amplifies downside risk. And so if we see a company go make an acquisition that's in a totally separate business line than where they currently are, and they do so with that, the history of acquisitions is such that they typically do not work out. And so when you add on leverage on top of it, it usually is not a good recipe for success. So when we buy a high quality business, but that business goes out and maybe does something to the business, makes an acquisition that makes it a worse business and increases the risk, that would be one reason we would sell. The second is the business is underperforming what we think. So when we buy a new position, we typically have some sort of thesis on the disruptions that are occurring are temporary, or maybe the business is under earning relative to what we think it will in a few years. And our objective is we would like to see the business improve off of where it is today to some sort of stabilized earnings power or cash flow generation in the future. If it turns out that what we thought was temporary turns out to be more permanent in nature, we therefore have underestimated the risk of the business and maybe the durability of the business, and therefore look to sell the position because what we thought was a high quality business maybe turned out to be less so. So a portfolio example of this is Donnelley Financial, which we sold, I believe last year. And so our whole thesis, or the majority of the thesis on Donnelley, was they have a software business that we thought would grow high single digits, low double digits for the foreseeable future. And the software business had higher margins, really good retention figures. And over the course of owning it, they increased the disclosures of the software business and the retention metrics of customers, and also through just my own work of trying to figure out who their customers are and what the retention was. It turned out that the retention figures were much worse than what I would have thought and what we expected. And so when the whole thesis is predicated on you have a really good growing software business, but it turns out that software business is maybe not as good of a business as we thought, and in the future there's risks of uh, the business actually declining because we're seeing a lot of customers move to a competitor, that causes us to question the initial thesis of, hey, do we actually have a good software business, or did they just maybe hit a couple of good contracts in that maybe overshadowed what would be an otherwise not as great business. So we ended up selling Donnelly because the software business just was not, in our view, not as good as what we thought it was in the past. And then the second part is the risk reward is no longer attractive. So maybe the stock appreciates. So maybe our thesis played out. Maybe the stock moved ahead of where we thought the fundamentals may go. And an example of this is Alibaba, which we bought in 2024 for around $70. Initially, over the course of about 2 years, the stock more than doubled. Yet, if we looked at what the earnings figures are and expected to be for the company, they were $9 when we initially bought it, and then are now expected to be $5.15 in 2026. So earnings are down somewhere around 40%, and that's a lot to do with their increased investment in AI and R&D and capital expenditures. And we can see this on the free cash flow estimates as well, which were 22 billion in 2024, 10.7 billion in 2025, and 5.2 billion in 2026. And so when we initially buy a position that has significant free cash flow, that's starting to pay a dividend, repurchasing shares, to now the free cash flow is declining, potentially going negative because of how much they're investing in the business, the risk reward, or what we initially had, was a high cash flow business, typically lowers the downside risk, because if the stock declined, they would just be able to go in and repurchase shares hand over fist. But now you've got a company that's generating significantly less free cash flow, reinvesting in the business into areas that we are unsure of the return on, and therefore found the position to be more risky. We did well on the position, and thus thought it made sense to take the profits and move on. So, other side of the equation is, when do we buy? Our goal is to find, like I've said, attractive risk rewards, and this means buying a company's stock for significantly less than what we believe the intrinsic value is, which creates what we call a margin of safety, or again an attractive risk reward. We may try and estimate the intrinsic value by, you can do different valuation metrics, you can do price to earnings, price to cash flow, you could do a discounted cash flow method, several different ways to do it. But in the end, we're looking to come to a conclusion using just different metrics, price to book, that where the stock is today is much less than what we believe the underlying fundamentals warrant. In this, we look for businesses that, what we call, have moats, have durable competitive advantages, where some other competitor is not going to easily come in and take market share from them. We look for strong cash flow generation. So they have free cash flow that they are able to either pay out as a dividend, repurchase stock, or go out and make acquisitions. And disciplined capital allocation goes right into that. We want to see the management team aligned with our views, in that if we view the stock as undervalued, they also see the stock as undervalued and are repurchasing shares. Or if the stock is maybe fairly valued, that they then pivot to a dividend program, because that would be a better use of capital. So how do opportunities arise, or when does a stock trade at a discount to its intrinsic value? historically, we found that there's a temporary dislocation, misunderstood financials, or short-term uncertainty. The market tends to sell off a stock when the business is going through some sort of temporary disruption, but the market is unsure of how long the temporary disruption is going to last, or if it may be permanent. And so, as Peter will talk about, Baxter, a company that's going through short-term headwinds, their earnings and their cash flow in the near term may be lower than what it would otherwise earn on a stabilized or go forward basis. But when there's uncertainty of when the earnings will recover, the market typically sells the stock first and then asks questions later. And then we size positions based on what we think the downside is and what the risk reward of the position is. If we think the stock has almost no downside because it has a really strong balance sheet, high cash flows, we may be willing to size that position higher because the downside risk of the position is much less than maybe a commodity business that has some leverage on it or is going through some capital expenditures. We look to partner with, just like what we look to find in other investment managers who we like to talk with, long-term mindset, ownership mentality, like-minded in thinking. And I think a perfect example of that is Angus Kelly for AirCap. Just somebody that you can trust in what they're saying is what they're going to execute on moving forward. So looking at the portfolio today, even with the small pullback, equity market valuations are still relatively high, though there's a lot of dispersion under the hood of the market. But the market is still trading at a relatively elevated valuation relative to where it's traded at historically, and thus we've chosen to maintain higher cash levels, which allows us flexibility should we see a larger pullback. I think, as we talked about on the last quarterly call, when the markets pull back, whether you're a good company, bad company, the market just shoots first and asks questions later. And it's when that occurs, you have the opportunity to buy high quality, durable businesses that the market is selling off because they just need to raise capital or they're fearful, and thus they don't care where they're selling it from. They just want to bring cash in the door. And so our goal right now is we want to prioritize capital preservation, have cash on the sidelines, because if that does happen, we're going to be able to buy securities that are at meaningful discounts to their intrinsic value. And today we're not finding a lot of securities where the risk reward setup is that attractive. So when we look at a position today, we can get a risk-free return somewhere around 3.5, 3.75%. How does that return compare to what we can find in the market, and how much riskier is the investment that we're looking at relative to that 3.5, 3.75% risk-free return? And today, even with the volatility, even with the dislocation, there's still not that many bargains to be found. So when this is the case, we're just going to maintain patience and look for opportunities as they arise, but believe that cash is not a real drag on the portfolio, but it provides optionality should a pullback occur.
So, Peter, do you want to lead us off with discussing the recent changes that we made in the portfolio? And Dominic, you can chime in as well as you see opportunities too.
Sounds good. Why don't we go to the next slide? So we had a partial sale of Corning about a month ago, and as the slide shows, there's a difference between a good stock and a good business. And so we still have a position in Corning, but we feel that there's reason to be cautious with Corning. For portfolio management decisions, we decided to sell some of the stock. You can see here on this chart, there's a peak, then a tremendous drop off, and then a relatively flat period, and then a recent run up in the price of the stock. And there's actually correlations between those two. In 1999, a company called Ariel Networks was planning on building a coast-to-coast wireless network. This is the company founded in 1999. They signed $1 billion contract with Corning, which was represented about 20% of their assets at the time, or 20% of their revenues, excuse me. And so Corning was rapidly expanding their plant to fill these fiber optic scenarios. And I was unfamiliar with Ariel Networks, so I decided to look them up. And it turns out that Ariel Networks was only founded in 1999, and they were a relative startup, but Corning had put significant faith in them. Corning stock dropped from $113 a share to $1.50 a year later. So if you can see that middle section after that big drop off, we've had an opportunity to add to all the Corning we wanted to for the last 15 years, and we did. As many of you who've been with us a long time would know that the number one question people would ask in financial reviews is, what's wrong with Corning? And we say there's nothing wrong with Corning. As a matter of fact, I think you ought to be adding to your position as they pay a strong dividend. They're the leader in fiber optics. They invented it. They have about a 60% market share, and they have a number of other products as well. Corning recently had a number of contracts and lots of write-ups and positive scenarios related to artificial intelligence, and their stock rose dramatically, and we felt it made sense to take some money off the table, so that's exactly what we did here. Now, coincidentally, within a few days of us selling the stock, we also sent out a video talking about all the positive scenarios are going on with the business. And so our main reason for selling some is for portfolio management reasons. I simply do not want Justin and the rest of the financial planning team to have a conversation with you and to try to explain to you why your $6 million portfolio is now at $3 million, and why we didn't sell some of the Corning when the stock price rose dramatically. And so we did, and we have money on the sideline and are able to purchase other things that we feel are better values, have extra cash, and just take a more conservative stance. Why don't we look at the next slide? Dominic, did you want to add anything?
Nope, you're good.
Okay. Dominic, why don't you cover BMW and Mercedes-Benz, and then I'll talk about the Tri-Point merger.
Perfect. So BMW and Mercedes, the thesis for holding them were both relatively the same. There were some concerns in the auto industry about higher interest rates and the go-forward effects of basically sales. You had a lot of demand when interest rates were zero back in 2020, 2021. And now that interest rates for an auto loan might have been 6, 7, 8%, the demand for cars was less. You also had entrance of BYD taking market share, Tesla taking market share. And so our view at the time was we're going through temporary headwinds on auto sales. BMW and Mercedes, I believe, both forecasted sales to decline in the subsequent year that we purchased it. But we thought that you have two iconic brands that they would be able to weather near-term headwinds. And they had very healthy balance sheets, both paid healthy dividends, that in a couple of years, we'd be back to a normalized environment, and demand for a BMW or a Mercedes would be higher than where it was today. Historically, auto companies are very challenging businesses. I think almost all of them have gone through a bankruptcy at some point. And I think just the main reason why we sold is the competition appears to be stronger than maybe what we initially had thought. And I would say it was more of a short term that the stocks were trading at very low, maybe mid-single digit earnings profiles. And if you looked at what they traded at versus what like a Ford, GM traded at, it was slightly below what they were trading at. And there's just like a value disconnect where you've got two iconic brands versus some other stocks in the market. And our goal was, if BMW and Mercedes stock would re-rate to a higher valuation where it was in line with peers, that it would be a good investment. If you also get some dividends along the way, I think the dividend yields for some of them were, or for both of them were in the 4 to 5% range. But in the end, we sold just because I think the competition is probably a little stronger than what we had initially expected. And if they're going to continue to cede market share, when you have a high operating leverage business, sales do not need to decline that much for it to take a meaningful hit to earnings. So we're worried about the earnings power in the next couple of years, and therefore lost confidence in the initial thesis that we had.
So Dominic, why don't I talk a little bit about the history of the TriPoint merger and how we first came in touch with Weyerhaeuser, and then maybe just talk a little bit about the acquisition price at $47 a share after I speak. We became intimate with, we started getting knowledgeable with TriPoint back in 2014 when Weyerhaeuser decided to spin off its home building unit, and they merged it in with TriPoint Homes, and the company went public at that point in time. So we decided to stay with our Weyerhaeuser stock and not own TriPoint Homes, and we followed that for a number of years. And in 2022, the stock became unloved and unwanted, which gave us a wonderful opportunity. The stock declined from its high of about $29 per share, was trading at as low as $15.05, and we bought in at about $17 a share. At the time, there was a lot of fears that higher borrowing costs would deter some potential home buyers. There was fears of a pending recession, fears of inflationary prices would reduce the demand for new homes, and also those inflationary prices would reduce profit margins. So, but anytime we look at a company, we also have to have reasons why we want to own it. One of them was Doug Bauer, as the CFO, had done an absolutely outstanding job with running the business. They were in very strong financial shape with both revenues and profits over the long run. There's the short-term fears we felt were not valid, and that the long-term housing demand should continue, and that the financial metrics appeared really outstanding on a long-term basis. The company also had been aggressively repurchasing its stock, and as I said, we really believed in the management team. So we were able to buy it at very close to its low over the last 5 years. And as many of you have seen, we added to the position not only at the $17, $18 level, but in recent years when it dropped, it went up to about 47 a few years ago, backed off, and we were adding to it in the $31, $32 range. And I think there was actually a major purchase as well. So Dom, why don't you talk a little bit about the merger that just recently happened and the sale of the company, the sale of our shares?
Yeah. So they sold to Sumitomo Forestry. I believe it's a Japanese company, and Sumitomo is trying to more vertically integrate their MSA lumber wood products business into now building homes. When a company goes through a merger or an acquisition, they file a proxy statement that details more information and background on how the transaction came about. And this process, I believe, it was around a year from when Sumitomo first approached TriPoint to when a deal was ultimately announced. And when Sumitomo first approached TriPoint, they offered them $41. And TriPoint said, "We're not for sale. You got to bump up your bid." Sumitomo then went back to their board of directors, came back to TriPoint and offered them 44. TriPoint rejected again, saying the price is below what we believe the fair value is. And then Sumitomo came back with their basically best and final offer of $47. And that's when TriPoint agreed to sell. And so we ended up exiting the position, I believe in like the mid $46 range, because there's only a couple percent left upside, and it was an all cash deal, so the stock was pretty close to where the ultimate closing price was going to be. The one interesting chart I wanted to show is the right chart shows TriPoint stock in orange, and the blue the blue chart shows the home builders index. So it's just basically like an aggregation of all the publicly traded home builder stocks and their stock price performance. And so if we look at what TriPoint has done, their stock is up meaningfully since the merger was announced or the acquisition was announced. But if you look at what has happened to the home builders index, it's down about 20 to 25% over that same time period. So at least in the short term, it looks like Sumitomo near top ticked what the prices were trading for home builder stocks was at. And that also means that the market or the home builders stocks are going to be cheaper today than where they were just a couple months ago when they announced the merger. So should we want to find other ideas in the home building industry, then we now have ample cash and the valuations today are cheaper than where they would have been just 2 months ago.
Oh, Pete, I think you're muted.
Go. All
There you
right.
go.
It's interesting how various ideas come to us. In the spring of 2024, Dominic said to me, Peter, there's a company out there that just did a write-up on their favorite companies of the year, and I thought you should listen to it because no one ever talks about the Bank of Ireland. So I decided to go and watch the video, and the part about the Bank of Ireland didn't start until like the 32-minute mark, but I decided to listen to the entire scenario there. And one of the individuals started talking about his favorite investment was Alibaba and how they had fallen on some difficult times from a stock price standpoint, but they were showing a lot of improvement. I was first familiar with Alibaba as my brother-in-law brought it to my attention after their IPO and talked about that it was something that we should consider owning. And I said, Johnny, that's not the way in which we do business. We're buying things that are unloved and unwanted, not things that are loved and wanted. We want to pay a huge discount to a company, not a premium. So anyhow, I was familiar with it and as the Amazon of China. So there, it turns out that the stock price had dropped from a high of about $325, it was trading very close to its IPO price of like $68, and we were able to buy it under $70. At the time, Japanese economy was weakening. The Chinese stocks were in a free fall and were unloved and unwanted, and also the tensions with the United States were there, and they had a profits decline about 77% in the third quarter of 2023. So we also knew on the positive side of things that Alibaba dominates the Chinese e-commerce market. They were expanding into Southeast Asia. They had a very strong balance sheet. They were aggressively repurchasing their stock. The securities had declined 75% from their high. And they had numerous growth opportunities in artificial intelligence, cloud computing, and other areas. And to make things even sweeter, they had $75 billion in cash and owned an extensive portfolio of other Chinese companies, including many AI startups, and they owned 33% of Ant Financial. We had never owned a Chinese stock before in my 46-year career. And so we really stepped out of our comfort zone there, and we felt that despite all the political tensions and things, that it was the risk reward was there. And so we decided to go ahead and make the purchase in Alibaba. And if we fast forward, the stock has risen dramatically. The company stopped buybacks. Their positive cash flow has turned negative as they've invested into their investment in artificial intelligence. But the price of the stock had risen dramatically, and we felt it was time to walk away, and which we did. Remarkably, in the very short period of time since we sold it, the stock has been in, continues to be in very much of a free fall. We sold at about 165, and I think it trades at about 125 today. Dominic, anything you wanted to add?
Nope.
Thank you. Well, the let's talk a little bit about the Fannie Mae common stock. You all know that we've been talking about Fannie Mae for probably 10 years, and the conservatorship that they're in. So we owned both Fannie Mae common and Fannie Mae preferred stock. The preferred stock being the more conservative investment, but as we saw a significant price decline when during the Biden administration, when it looked as if the conservatorship wouldn't end anytime soon, we were able to buy shares at under $1 with some of the proceeds from our sale of our partial sales of NVIDIA, as well as in other investments. It had a tremendous run up, and our portfolio became oversized in the Fannie Mae common and preferred. And so we chose to take our money off the table and sell the common and keep the more conservative preferred shares. And once again, as I mentioned with Alibaba, in the short period since we've sold it, it's had a tremendous sell-off. We're not trying to outguess the market in the short run, but I don't ever remember in my career where two companies that we sold at what we felt were fair values were to drop off so dramatically over the next several months. Dominic, any comments on your behalf?
Nothing to add.
Okay, you sound like Charlie Munger. All right, let's talk about the Baxter purchase. Baxter, like so many of our investments, is unloved and unwanted, and for really, really good reasons. The management team has screwed up incredibly. I'm sorry, the former management team did, and they made a number of missteps, including the overpayment of the Hillrom acquisition in 2021. They had one of their infusion pumps was recalled, and of course, their debt load became higher than most investors are comfortable with, including us. But we felt there was several reasons which to own the business. They have a dominant share in many of the pharmaceutical areas. They brought in a new CEO who is focused on deleveraging the company. Now, the stock price had declined from 95 to 17, so it gave us a wonderful opportunity to buy just an outstanding business at a huge discount. And part of the things that was wrong with it, this is a company that has a wonderful history of paying nice cash dividends. Well, they're all but gone, except they're paying a minimal 1 cent dividend per quarter, down from like $1.16 per share. So it's a huge difference there. So what we're looking for is operational improvement in both their cash flows, improving debt, and reducing that. We're in the very, very early stages of that. This is very much of a transition year, and very much like what we had with Compass Minerals last year, it seems like a very, very similar scenario there, where we have a new management team focused on reducing debt and improving cash flows and reducing debt. So hopefully the Baxter purchase will show a similar result than what we've seen in the 1 year holding that we've had with Compass Minerals. Dominic, anything you'd like to add?
No, I was going to say the same thing about Compass. You got a new management team. Setup seems very similar, and I think that's the pattern recognition that we look for, and why we try and study history so much is what have we seen before that's similar to this, and how has it played out? And I think Compass is a great analogy for what we see.
And I think one of the things to mention also is, do not expect all our investments to work out. If all of our investment worked out, we simply wouldn't be taking enough risk. There's going to be things that are going to cause a wonderful investment that looks like a great deal when you first get into it, where it's going to turn negative. So it's been a phenomenal quarter for us. If you look at your capital gains on your account, you're going to be maybe a little bit shell shocked, but that's the nature of having strong performance when you sell things off. But our job is to be stewards of your wealth and to try to analyze the risk and reward and act accordingly. Why don't we open things up for questions, Carly?
Sure. So we're going to move on to the question and answer portion of the call. We had one pre-submitted comment, and it was that they would love to hear more about Corning at this investor call. I think we pretty much went through that scenario, so I'm not sure if we have anything to add on Corning, but just wanted to let you guys know that we received that.
The only thing I'm going to say on Corning
Sure.
is you're trying to balance right now. Corning, the data center build out on AI is still relatively early. So the position in Corning is a balance of how long does the data center build out take? How much money are these Google, Meta, Microsoft going to pay? And versus what Peter talked about in the past of, hey, they've had orders in the past that have gone away and materially affected the business. So it's just a balancing act of where are we in the cycle versus what has history told us about the company.
On St. Patrick's Day last year, I attended the Corning Investor Day at the New York Stock Exchange, and Wendell Weeks talked about that there was going to be a transition from copper used in data centers to fiber optics, just as there had been with telecommunications back in the early 90s. Now, if you've listened to Wendell Weeks, he always seems optimistic, and we did not add to our position because we already had a huge position in Corning, and I was quite surprised to see the way it took off from the $40 area last year, and when it was starting the trading at really high prices, I just said I'm willing to walk away from some of this, even though the momentum certainly is in Corning's interest. We sold the shares at about 120. It then quickly moved up to about 160 a few weeks later, and I think it's now it backed off to about 125, and I think it now trades at about 140. So it's clearly become a momentum stock, and of course we benefited from momentum stocks in the past, with especially ones like NVIDIA.
All right, and we had some questions submitted by people on the call. The first one is the Fed had a meeting today holding rates steady to hold inflation steady or trend down. How do you see this news helping the effect of tariffs, and more on what you said about inflation?
I can start and you guys can add in. I mean, I think you got to understand that there's a balancing act going on here. Politically, we're heading into midterm elections as well. Obviously, with that news and the recent announcement of a 2-week truce period with Iran, that we saw markets take off today, right? And this is a very news-driven market environment that we're in right now. But stronger financial markets bode well for the incumbent, and I think we're going to see a lot of this in the coming months, where we have somebody who's very interested in keeping market prices elevated because it bodes well politically. Inflation is not going to respond to those political maneuvers. It will be a function of supply and demand. And so what you're seeing today, I believe to be short-term noise. I think longer term, or more midterm rather than long-term, going out a few months, that the seeds have been sown already for higher inflation. We could argue about whether or not the Fed raising rates is the appropriate move to curb inflation. And we would never come up with a conclusion there. Looking historically, if we go look backwards, that has been the typical response. I do not know that that will be the response next time, but history being our guide, and it's a pretty good one and the only one we have. My feeling is that we probably will see some increases in inflation, and therefore the Fed's current posture on rates may need to change as that inflation unravels. Dom, do you have anything you would add there?
No, I mean, normally the Fed, I think, waits until it's blatantly obvious that you have a problem at hand, whether it's inflation or deflation. So they're not going to raise rates until it's very obvious that inflation is becoming a problem, and they're not going to cut rates until it's obvious that inflation is under control. So right now we're, I think, more like a waiting period than anything on the Fed side. So I think, just broadly speaking, one of the things we look at is just like, we come into the year, people think that we're going to get 2 to 3 interest rate cuts. Now we've switched to people think that rates are either going to stay steady or increase, and just goes to show you that people are just guessing at what's going to happen, and nobody really knows what's going to play out. So taking a stance on what we think is going to happen with interest rates is just like a fool's game.
Yeah. Pete, how about you? What would you add to that?
I would add to it is that over our lifetime, all of our lifetimes, we've experienced inflation. And the most important thing is, as you know, from a financial planning perspective, is to have a plan, follow that plan, and you're going to be all right. Trying to outguess what's going to happen in the economy is an absolute fool's decision to make. But if you're living within your means, are saving for your future, and are taking advice and working with us as team members, you are going to be financially secure for the rest of your life, and that's exactly where we want you to be going.
All right. We have one more question that was submitted during the call. It said HCC has been a great performer for all in the portfolio. Having said that, has there ever been any consideration reducing the position given the run-up and some of the market volatility, or is there still great optimism on the coal mining market segment?
Peter, why don't you start?
Sure. We purchased Warrior Met in 2019 at about $28 a share. Shortly thereafter, COVID hit, and it went down to about $11 per share. And we added to a number of clients' positions, as we did of other investments that got hit very hard. Then the met coal prices started rising pretty dramatically, and they were kicking off a tremendous amount of cash to us. Along the way, they decided to grow the business and to invest $1 billion into a new mine called the Blue Creek mine. And with the rise in coal prices and the tremendous cash flow that was kicking off, they were able to fund the $1 billion cost all internally and not have an outside partner. That was just completed 8 months ahead of schedule, just like last month. I think it's now time to enjoy the benefits of that huge investment that we made, with cash flows that should be coming to us over the next several years. Even though it's an oversized position, we're comfortable having an oversized position in your portfolio, and at least I'm comfortable to have an oversized position, and I think we'll enjoy the benefits of that over the next few years. Anything you want to add, Dominic?
Yeah, when we met with the team, it seemed pretty apparent that they are going to pay out dividends with the cash flow that they generate over the next several years, versus doing share repurchases. And the dividends are basically going to de-risk the position, in the sense that we're now taking basically cash out of the business and able to deploy it in other ways. So what might be a large position today, the dividends that we expect to receive over the next several years are going to make it such that the position isn't going to grow, I would think, materially beyond where it is today, because all of the cash flow that the company generates is going to be returned to us as shareholders. So I think it'll basically normalize itself out just through that process.
Yeah, and I think part of the reason why they choose to pay cash dividends as opposed to buying share repurchases, I think they started repurchasing some of the stock at 24 and then at 23 and 22 and 21, 19, 18, 17, 16, 15. And they thought to themselves, what the heck are we doing here? All it does is go down. And they stopped the share repurchases and moved to more of a cash distribution. Quite frankly, I wish they would have continued to do the share buybacks, but I'm not running the management team. They're doing the capital allocation as they believe it's in the best interest of the shareholders. But when we have a history like their repurchase history that they had, and anything that happens that's kind of traumatic in your life, we make adjustments that make sense and isn't necessarily always what makes sense. But quite frankly, if it was my decision, I would have bought back the stock at those lower levels than even though it continued to look like it was a fool to be doing that. But that's looking at the world through 2020 hindsight, which is totally unfair to the management team. So let's just end it on that.
Thanks, guys. Yeah, it doesn't look like we've had any more questions submitted, and we're right at our allotted time for this presentation. So I think we can end it here, if that's okay with the team.
Yeah, thanks everybody for being here. And, we will get this call up on our website and YouTube channel within the next day or two. So if you need to go back and review any of this information, it's there for you. So thank you all for being here today.
Yeah, thanks everybody. I'll be
Thanks
putting
again.
this up on our website and our YouTube channel shortly after this. And again, if you have any questions that you want to submit for these calls ahead of time, just feel free to email any member of the team and we will address those on our next call. So thank you very much. Thanks for joining us.
Thanks, everybody.